Good morning, dear students. Today we are going to discuss about the methods of credit control provided by RBI. We all know that Reserve Bank of India is the apex institution which controls, coordinates, and regulates the monetary functions in the Indian economy. So that they have introduced the methods of credit control in order to liquidate the money supply or the monetary supply in an economy, in order to maintain stability in the demand and supply in the monetary in an economy. They have introduced these two kinds of techniques, and the major objectives of introducing such credit control method is: the first one is in order to stabilize the internal price level of an economy, and to maintain or to obtain a stability in the foreign exchange rate of which will maintain the external value of the Indian currency also. And the third objective is to maintain stability in the money market through liquidity control measures. Good morning, dear students. Today we are going to discuss about the methods of credit control provided by RBI. We all know that Reserve Bank of India is the apex institution which controls, coordinates, and maintains the monetary policies in the Indian economy. So that today we are going to discuss about the objectives of credit control techniques which have been introduced by the RBI, and also the two major methods of credit control techniques. So that why they want to introduce a credit control function, because they want to stabilize the demand and supply of money or the monetary or the liquidity in an Indian economy, and also to limit the credit volume which have been created by the commercial banks, and also to regulate the credit volume, and also to direct the credit to productive uses. They have been introduced these two major methods of credit control techniques, and the major important objectives of introducing these credit control method is that the first one is to attain the stability in the internal price level, and also to obtain a stability in the foreign exchange rate which will maintain the external value of the currency also. And the third major objective of introducing a credit control method is to maintain stability in the money market through making liquidity control measures, and to promote the overall economic growth and development, and also gradually they will promote the national interest of the economy. So that these are all the major objectives why the RBI or the apex institution they have been introduced a credit control technique. And next one is the methods of credit control provided by RBI. They have categorized it into two major parts: quantitative credit control methods and qualitative credit control methods. In that, moving on to the first technique, quantitative credit control methods or general methods. The aim of introducing this quantitative method is to regulate the total volume of bank credit. So that in that they have categorized it into four: bank rate, open market operation, cash reserve ratio, and statutory liquidity ratio. So that moving on to the first quantitative credit control methods, bank rate policy, which means the standard rate at which the Reserve Bank or the Apex Bank is prepared to purchase or buy or rediscount the bills of exchange or other commercial papers from the banks. So that in the bank rate policy, there are two situations will arise: when the bank rate is lower, second one is when the bank rate is increased. So that the first case, when the bank rate is lower, which will lead to get the credit at a cheaper rate, and also it will cause expansion of credit, and it will rise as the economic activities gradually the price level also. Then the second case is when the bank rate is increased. So at that time the bank credit become expensive, so it will gradually cause a decline in the availability of credit. Gradually it will lead to a decrease in the economic activity due to the cheaper availability of the credit. So this is the first quantitative credit control method. Second one is open market operation. But before that, in the bank rate policy, there are again it is classified into two: repo rate or repurchase rate, and reverse repo rate. So that repo rate or repurchase rate means it is the rate at which the RBI lend funds to commercial bank and other financial institution, which means RBI will lend funds to the commercial bank and other financial institution at a particular rate of interest. Currently it is 5.90%. Second category of bank rate is reverse repo rate, which means RBI invites commercial banks and other financial institutions to deposit their excess idle fund to RBI treasury, and for that deposit they will introduce, or they will give, that is the RBI will give a certain percentage of interest rate for the deposit they have been given to the RBI. That is currently it is 3.35%. So that bank rate, which will also include repo or repurchase rate and reverse repo rate. Second one, or the second quantitative credit control method, is open market operation, which means it consists of the purchase and sale of government securities in the open market. It is done in order to regulate the monetary supply in the economy. In that also there are two conditions will exist. First one is if there is excessive supply of money. So at that time, if there is an excessive supply of money or there is circulating excessive supply of money in the economy, means the RBI will sell the securities in the open market in order to withdraw the excess monetary supply in an economy. So this is the first case where RBI will operate this second quantitative method when there is an excessive supply in the economy, money supply in the economy. The RBI will sell their securities in the open market in order to withdraw the excess money. Second case is that if there is a shortage of money in the economy, that RBI will purchase their securities from the open market in order to make available the money for the circulation in the economy. Moving on to the third one, variable cash reserve ratio. The name itself depicts that cash reserve ratio will vary. Okay, so that for every scheduled commercial bank, there is a percentage or there is a fixed percentage that they are required to maintain a fixed percentage of their time and demand deposit as a cash reserve with the RBI. Currently, it is 4.50%. Okay, but there are also two situations will arise. If there is an increase in the cash reserve ratio, mean it will reduce the excess reserve with the bank, and if there is a decrease in the cash reserve ratio, mean it will increase the reserve that will be kept in the commercial and other financial institution. Then the fourth and the last quantitative credit control method is statutory liquidity ratio, which means it is the ratio of banks' liquid assets to their net demand and time liabilities. That is the minimum percentage of the deposit that a commercial bank are mandatorily to maintain as gold assets or cash or government approved securities. So that these are all the four major quantitative credit control techniques. The first one is bank rate policy, which will also include repo rate and reverse repo rate. Then open market operation, then the variable cash reserve ratio, and the last one is statutory liquidity ratio. Moving on to the next category of credit control method is qualitative credit control techniques. Qualitative methods, or it can be also called as selective methods, in that the first one is fixation of margin requirements. That is, according to the needs of goods and services that a customer or a borrower want, the RBI will fix a margin. That is, it can be a lower margin or it can be a higher margin in case of interest rate. So that lower margin will be fixed in to the borrowers whose need is urgent, and those activities which are essential for the borrowers and that are not aggravating the price of the commodity, that is mainly for the essential goods. So those borrowers who want to purchase such kinds of essential goods that is necessary for their need or urgent, whose need is urgent, for those borrowers, the margin, that is the interest rate for such loans and advances in order to purchase these kinds of essential goods and services, for those borrowers, the interest rate will be or the margin will be lower when compared to other loans and advances. But in case of those borrowers who want to purchase luxury goods, which means their needs and wants are not urgent, and these kinds of activities will also aggravate the price of the commodity and also the economy also. So in that case, for those borrowers who want to purchase these kinds of luxury goods and services, a higher margin will be provided. These kinds of higher and lower margin, why they are introducing such kind of higher and lower margin, means they want to make a stability in the market or the economy in case of the monetary supply. This is fixation of margin requirement. Second one, credit rationing, which means they fix a ceiling or a maximum limit on loans and advances of various categories which a commercial bank cannot exceed. That is, if a commercial banks want to give loans and advances or avail loans and advances to a particular borrower, means the RBI or the Apex Bank will provide a ceiling limit that all the banks or commercial banks and other financial institutions have to follow. Their ceiling limit or the maximum limit on loans and advances should not vary or should not exceed. This is also in order to make a certain reserves and reserves or So that in order to make a maximum limit on the loans and advances on various categories that a commercial banks cannot exceed, it will control the credit amount and also the reserve amount that will be kept in a bank and commercial institutions and other financial institutions. So that is why they are introducing the second qualitative technique, that is credit rationing. The third one, or the third method of qualitative or selective credit control method, is regulation of consumer credit. That is, according to the needs and wants or the behavior of the purchaser or the borrower, we have to give or we have to set a time frame for the, or a minimum time frame should be maintained in case of interest rate, also for the repayment of loans, so that they will repay the loan within the time frame. So it will also enhance the credit volume and also it will control the credit in the economy. Fourth one is control through directives. That is, directives may be related to advances. That is, what are all the amount that will be given to a borrower according to the needs and wants of the particular behavior of the borrower. And also, a margin should be maintained. These all things should be already in a written format. That is, every banks or commercial institution should maintain a directive, and they have to follow these kinds of directives or regulation in order to control the credit in an economy. And the fifth one is moral suasion, and that the major 4 points are they have to follow certain line of policies. Every bank, commercial institution, financial institution, and also all the institution have to follow certain line of policies, which can be introduced by their own or it can be from their regulatory bodies. So they have to follow certain line of policies while they are giving loans and advances to the particular individual customers or an institutional customers. And second one, they have to go through a necessity of credit restraint. They have to categorize what are the necessity of the borrower, whether they want to purchase an essential goods or a luxury goods. So they have to differentiate the necessity of the particular credit restraint. Then urgency of deposit mobilization. Then the next one is employment of funds in priority sector. So the moral suasion is the fifth technique which introduced by the RBI because they want to check whether all the banks or commercial and financial institutions are following their line of policies, and also they are giving or advancing the credit to the individual or institutional customers according to their necessities, and these kinds of idle funds are channelizing into the productive or the priority purposes. And the next one is publicity. Publicity means every bank's information should be publicly available because they want to educate the people regarding the credit expansion and the contraction, what are all the activities or what are all the interest rate provided by different types of bank for the loans and advances as well as for the deposit, what are all the interest rate all the commercial banks and financial institutions are providing. Such kinds of general information should be publicly available in order to educate and to inform the people. Last one is direct action, which means if any of the bank is refusing credit to the needy customers without any prior reason or prohibiting of any of the credit to the needy customers, the regulatory authority will take direct action because of these kinds of actions provided by the commercial banks or other financial institution. So these are all the different types, or these are all the two major techniques provided by the RBI in order to control the credit, which will stabilize the price level in an economy and also the foreign exchange rate in an economy. They have introduced these two major credit control methods, quantitative methods and qualitative credit control methods. Hope you are all clear with this topic. Thank you.